Welcome back to lesson 13, and in lesson 13 we will look at the weighted average inventory valuation method. In lesson 12 we did the first in first out method, and now we will do the weighted average. You will remember in the first in first out method, when we sold items or when we used raw material, we took the old products first, and the ones left at the year end were then normally the ones, the most recent purchase. All right, so with the weighted average, how will we record this, or how will we attach a value to the inventory? We will take the total cost of inventory. So in other words, the total price that we paid for all the inventory and divide it by the number of units. Now, for now, remember, when we are saying number of units, we are talking about similar units. So let's say we manufacture calculators, then a unit will be a calculator. Now, what is the advantages of the weighted average? And the first one, it's useful when your cost prices fluctuate. So in other words, when you frequently buy items at different prices, then to attach a value to the inventory, it will make more sense if you use the weighted average method. And we actually said that with the first in first out method, it was not convenient to use that one when you frequently bought at different prices. Then also you will have a higher value of inventory in your balance sheet. Why is this? Remember, as you buy at new prices, the price of the old stock or the price of the stock that you bought at lower prices will now increase also. So you will have a higher value of inventory in your balance sheet, so your assets will decrease, your assets will increase. Then to compare between different periods is a whole lot easier, and the average values will be close to your current market values. So you can easily if you then rather look at current market values, those should be very similar to the average value that you calculated by use of the weighted average method. Now, the disadvantages of this method is that we are not using actual prices in the financial statements because we are using an average. The financial reporting can be manipulated. Why do I say this? Because you don't use actual prices, so management can manipulate the financial statements. Then also this calculation is a bit more complex, and there can be some errors, human errors, while doing these calculations. Now, this is our first example, and we are buying and selling calculators. All right, so we bought 100 calculators at $50 each. Now, let us first calculate the value of this 100 calculators, and we will say the value is 100 calculators times $50. So we will say the value is then 50 and 2 zeros, so the value is then 5,000. So this is my value of stock. I will just say value stock. Now I'm selling 70 calculators. All right, so let's sell this 70 calculators. So it's 70 times, and remember the price was $50. So what will go out of my stock is then $3,500 Namibian dollars. This will go out of my stock. So the value that I have left is then a 5,000 less my 3,500. So I will have 1,500 or 1,500 Namibian dollars left. This is then, my value is then 1,500. 00. This is then the value of my closing stock. The value or my cost of goods sold is then the one that you sold. So you sold 70, you bought it at 50, so that will be the 35. So I will only write it there. My cost of sales in this example is then 35, and remember then my closing stock is then 15. Alright, so this is now quite easy up to now. And why is it easy? Because you still did not buy new items for different prices. So the value of my closing stock now is $1,500, and it consists of 30 calculators of $50 each. And now I'm going to purchase 50 more calculators, but now I will pay $60 each. Alright, so I have 30 calculators at a total value of 15. Now I'm going to buy 50 calculators at $60 each. And this will cost me then $3,000. Alright, so what is the value of my stock at the end of this purchase? I had 1,500 Namibian dollar worth of stock, and now I bought 3,000 more, so my total stock now should be 4,500. Alright, so I paid in total 4,500 for how many units? For 80 units. So 80 units is worth 4,500. So what is the value of 1 unit? So now I will say 4,500 Namibian dollars is the value of 80 units. So what is the value of 1 unit? I will quickly do that. Then I will get that the value for 1 unit is now 56.25. So now you will see that although you paid only $50 each for the first 100 calculators, the value is now 56. And this is what the advantage is for this method, because now your inventory or your current assets will show a bit more because you are now using 56 instead of 50. So now I go a bit further, and you will remember now my value per unit is 56.25 because I've spent in total 4,500 Namibian dollars for 80 units. So then per unit 56.25. Now I'm saying that I will sell 10 calculators, and I want you to calculate the cost of sales of the 10 calculators that you will sell. So the cost of sales of 10 calculators, and then also the value of your closing stock. Alright, so let's do the first one, and we say cost of sales. We are selling 10 calculators, and what is the value of a calculator? We said the value of a calculator is 56.25, and I'm selling 10. So the cost of sales is then 562.50. My cost of sales for 10 calculators is then 562.50. Alright, then the second requirement, what is the value of my closing stock? Alright, the value of my closing stock was 4,500, and now I sold, or I took out of my stock 562.50. So now I have left, let me just do this calculation. So I have left in my stock 3937.50. Alright, so this is the weighted average. We will do another example in class, but this is just to give you some idea, some sort of idea of how you will do the weighted average method. Now, I just want to introduce you to something more, and that is the perpetual and the periodic inventory systems. So the difference in these two, and I will start with the periodic. You can see the word period there. All right. So it's something to do with the period. There's your word period. So this means with this system, the accountant or the business will only, at the end of the period, do a calculation of cost of sales at the end of the period. So they will normally do a stock count, and then they will calculate cost of sales. All right, so this is only once. So you will remember when we did now the weighted average and also the FIFO, the first in, first out, we calculated the stock levels and the value of the stock after each transaction. Now with a periodic system, you won't do it like that. You will only towards the end or at the end of the period, at the end of the year, you will then calculate your cost of sales. While with a perpetual system, you will, after each transaction, calculate your cost of sales. So what we did in these two lessons, we used the perpetual system because we calculated cost of sales and the value of the closing stock after each and every transaction. This is then, we did now the two valuation methods, the first in, first out, the weighted average. We did the calculations, we looked at the advantages, the disadvantages, and then also just what is meant by a perpetual system and what is meant by a periodic system.